Weekly update for the stock market. It is October 1st, 8:04 a.m. Eastern Time. So we got a new quarter underway and the fourth quarter of the year, and we've got a new month underway. And yet it's the end of the week here, and I think a lot of people have been beaten up, and those who don't feel beaten up, even if they did a glorious trading and changing here for this entire decline, they even say this has been brutal, okay? And I think a lot of people thought this could be one of the few times that we just ride through this debt ceiling. We've learned a lesson and things will be fine. And no, it's turned out to be a battle. So yesterday they voted to do the spending, the additional spending, filling out here. And it was signed by Biden late yesterday. And then they got excited, the infrastructure bill voting. And first, the market actually fell as it was going towards the time to vote, because someone said they won't vote till 9 o'clock or later. And then they started rebounding, and then as the night went on, the market went back to selling again because the vote was delayed. And this morning I have not bothered to really get up to date how that process is going. At least we've got that spending gap kind of thing taken care of, and that's going to help for a while. But the infrastructure bill, if it gets passed, I think it's a long-term bullish scenario, but it may disappoint people short-term if it comes in smaller spending than what they anticipated, because that translates to less business and therefore less support for the economy. And if it were to be delayed for quite a while and dragged down for quite a while, that might frustrate the market. But frankly, I don't know if it's really that important at these price levels and with the growth of the economies globally and the U.S. And I think in this position of the bull market, I don't know if that matters that much. But again, we could see some short-term disappointment out of that and some frustration over it. And I think ultimately, the larger it is, the more bullish it'll be long-term. Now, what's more important here is whether or not they raise the debt ceiling, which they haven't done anything. And so I think we got a battle next week of the debt ceiling. From what I understand, that has to be taken care of fairly soon as well. So I think that's what's going to, if this market has to go lower later, in, say, next week or even today, I think it's probably going to relate to disappointments over that debt ceiling. Okay, so those are the things we got to watch here. And today we're going to get the PMIs manufacturing from two different companies, ISM and then Markets, although they have other names as well for them, for that group. Markets will provide the global and per country and U.S., and then ISM will provide a U.S. Alternate number here, and this will tell us how the economy went for September, how it grew, and it does look like I wouldn't be surprised to see some sluggish numbers. And then, of course, this is that time of year for consumer sentiment and confidence to wane. People naturally get a little pessimistic. September and October are poor months for the stock market. And unfortunately, I got caught up in the idea this would be one of those years that didn't work, because I felt like over the prior 10 years versus the prior 50 to 100 years, it hasn't worked as well, in my opinion. But it looks like it worked pretty good this time around. And it's been a little bit stressful here. And then, of course, the debt ceiling added to that, making it more volatile. So let's go to the model output analysis here. And you can see this line. This is, first of all, a 3-hour candlestick chart. Candlesticks are just another version of what you might see for a bar chart. At any rate, we were forecasting a level 4 bottom right within this time frame. And notice during the night, it bottomed one 3-hour candle or bar, whatever you want to call it, earlier than the latest allowed. And we've had a strong rally back up into prior downside targets that had been support, meaning it was a level where they stopped selling, and then the buyers stepped in and bounced the price. So it's back to this level. Now, it may hit its head here now, and when you break a prior support level, it can become a new resistance level where it'll bump its head, and it may go lower. Well, as we dig deeper, what we find is it was supposed to be a little top during this time, and it was. They slammed it up yesterday and then slammed it down. There's supposed to be another little top in this time frame, so it may top now, but it might have topped a little bit during the night and didn't really work all that well. We're in a side of a larger time to top, so it can top sometime today and set back, and there's a bottom due late today on into, say, Sunday night, so they could ease this back. And then there's another little chance for a bounce. But here's what we want to focus on, is I think more important. If this truly is a level 4 bottom, normally it would rally into a level 4 top. Now, sometimes these level 4s just don't rally much at all. They don't really work, but you usually get some kind of tiny little respect or something there. At any rate, the level 4 top is due like late during the Sunday, Monday morning overnight. It would be early Monday morning for a top, and then sometime all day through Monday. So in theory, this market should rally into Monday. So I think we got a bottom. I think they're going to buy today, even though they're nervous this debt ceiling is not fixed yet, okay? And the infrastructure bill is not fixed. I think there's a chance this market's so oversold and beaten up, and if I'm a bear and betting on the downside, I don't know why I wouldn't take some profit ahead of the weekend, just in case something happened that they fixed the debt ceiling over the weekend. They probably won't. So this may be no more than a knee-jerk reaction in this L4, but it might be something impressive as well, okay? Now, Monday to Tuesday, we'll probably see an L4 downswing. And probably somewhere from Tuesday, Wednesday, we're going to see an upswing. And Wednesday, Thursday, we're going to see another downside. That's how the L4 swings work during a week. And I call them swings, not actual trends. Okay, it's kind of like more transactional business, but it can be the beginning or ending of a more serious trend. Okay. And here's the thing. The model's saying that after that revision yesterday that I warned you late in the day, this is a level 3 uptrend. This is a level 3 downtrend. And that's your largest trend for the month. Now you're getting into more serious business that can relate to news cycles. Yes, the news cycle can relate to level 4 for just a quick pop during a day or a quick drop. But it can now relate to a flow that gets people excited and keep it moving. And it can even cross over into some fundamentals in economics, okay? And what we're saying is that this level 3 met the minimum requirements as of last night. After 12 a.m. or later Central Time, it met the requirements, minimum requirements for a level 4. And in a way, it met the ideal requirements because they tend to favor early over late. What this means is this level 4 rally could be the first leg higher of a brand new level 3 trend that's up for all of next week. But the problem is we're still stuck with this debt ceiling, and the politics and the market has been so sensitive to it that we have to be considering they may remain sensitive to it and they may get discouraged and sell more. So unfortunately, what we don't know is maybe it bounces for level 4 and then they hit it hard Monday and maybe even into Tuesday and put it even lower still, lower than what we've seen this week. And the level 3 delays. So unfortunately, level 3 can bottom anytime next week. A level 3 top shouldn't show up to near the end of next week to the following week. So it could take a while to find that bottom, and it could rob from the amount of time it can rally in that level 3, which also could be a sign of even greater problems and complications for maybe the month of October. But I think what's going on is there's a good chance that the level 3 is in today. Somehow or another, they're going to fix, okay, this complication and problem that we've been looking at here for the recent weeks, okay? And I think this market can rally higher. Now, for the moment, we don't have much for upside objectives, how this is going. I have to use retracements here, so it could be that they're going to run it to 43.40, something like that. It could be running up into this little range in here in the 50s and 60s, 70s, 80s. We just don't know. I would prefer to find a little fluctuation during the day and on Monday to come up with a little upside objectives here. And I don't know if we can update you that. We're really not a level 4 interweek day trading type service, okay? All right, any rate, I'm kind of encouraged that just maybe, they've sold enough to say, we don't give a damn whether when they fix this debt ceiling, as long as it gets fixed, we can put these prices up and nibble at it and we'll manage it. But they're obviously, in terms of managing it, they're going to manage the risk. They are going to worry. When do we get this debt ceiling fixed? Okay. We can still go into default even with spending, even with that little spending thing they signed yesterday. All right, so here's the daily chart. We're zooming out. These level fours look like these little pops and drops on the daily, and sometimes they don't really add up when you look in the intraday. They don't add up quite as the way it looks. But this time around with that revision yesterday afternoon, put this entire intraday level 4 scenario right in line with what we can just visually see on the chart, and it's time for not only a level 4 bottom, but the first opportunity for a level 3 bottom. And I say ideal. We got an oversold technical indicator warning, hey, they should have sold enough. It's time for some kind of a bounce, and it's trying to roll over to a buy signal as we move above the prior day's close. That raises confidence that if we get a buy signal, it can work. Whereas if we get the buy signal, but the close was actually a little lower, that would lower confidence. We need actual higher closes. Now we do have the 5-day averages nearby resistance, and we have this range now to watch out for potential resistance on the way up. It had been support that worked. Look at this. Worked to perfection here. Worked to perfection in here, especially on an intraday basis. But look at that, even on a closing, opening basis. Then it worked perfection for that middle line, which when it comes to the critical point projection, which is what this is, if you force me to pick a single number, I'll always pick the middle line as the ideal target. Found support, kicked off. Look at the size of that rally. Worked, beautiful. Come back, touched it again. Again, open and close, touching it to perfection. Rallied, come down, stopped right at the lower line. Perfection. And then it slammed down overnight, but look at that. It's already back above. And of course, some people say the close is more important than what occurred during the day. So hopefully we're going to get some follow through that it should not top Monday until Monday, and maybe even into early Tuesday. Okay, but we'll at least go for Monday. And again, Tuesday, Wednesday, we'll get some kind of setback. But the key is, if the level 3 trend is up through next week, then the downswings of the level 4 should not be as large as the upswings of the level 4. Otherwise, you don't have an uptrend. Okay, the swings inside that trend have to have higher highs and higher lows. And there is a chance to get it. I just have to warn you, there is a minor rule violation in the model that really this should have taken a little more time than this, especially when looking at weekly timelines instead of daily. So we are at risk. They're still going to set this back Monday, Tuesday, and it may come from discouragement of not fixing the debt ceiling. We can be early on making a call, but I am making a call anyways. I'm calling a level 3 bottom in place and warning you I can be early throughout all of next week. I'm hopeful no more than early next week that it only will take a couple more days to resolve this issue on the debt ceiling and resolve this issue of people just selling, and they're selling just because of the worries of the future over the debt ceiling. And they sold aggressively because they made so much money this year. They said, I just don't want to give any back. And that's irrational thinking. And they held out the best they could, and they reached a breaking point, and everybody just ran for the same door. And in my opinion, this market is actually a little bit undervalued by some trends. On a long-term basis, this market will probably be overvalued for a very long time, and it'll become more so. All right, anyways, hopefully we get a higher close today. Hopefully we get a buy signal on this technical indicator. Hopefully it rallies all of next week. But we have to consider things can go wrong because we've got an outside kind of factor, meaning really the stock market is 80-90% about consumerism, the consumer, and businesses, and we the people, and it's not about the Federal Reserve and the government and the Treasury. Unfortunately, we've got to focus on that 5, 10%, even 2 or 3% more than everything else. We're kind of like forgetting of what the economy's doing. And the economy's moving forward, and even if we get weak PMI indicators today, I don't care. And the model isn't going to change anything. That would be just a fluctuation along the way and something seasonal, and we will more likely see better news in coming months. We think this stock market's going to rally. So I'm now going to switch to the weekly chart so we can get an idea of what's going on with these larger trends, because not only am I calling a level 3 bottom, but I'm now, if you recall, a week ago called level 1 bottom right on this day, pretty much called it, and level 2. I might have called level 2 first and then revised it to level 1. I forget. But I'm now calling level 2, level 1 bottoms. Level 1 meaning the most important kind of buy signal, bottom signal, bullish signal you could come up with during a year, but there's more than one. And one of those level 1 bottoms could very well be the low of the year. And when we're looking for long-term bottoms, we need a level 1 bottom. Well, we're not looking for a long-term bottom. The long-term bottom was last year. We're going to get a minor long-term bottom next year, meaning one of those level 1s would be a long-term bottom. There's going to be a top ahead of it. We are due for some kind of correction as large as this one, if not larger, okay, sometime next year. But let me zoom out to weekly and discuss more of that. So we'll go to click on weekly. And we want this right here. Okay, so they violated last week's low, already bounced in. Sometimes it's fascinating. People put stops close to a low. They get taken out, but it's like someone else had limit orders and they wanted to buy that new low. They were that brave. They said, take a shot at it. Well, it's working for them. They're right for the moment, but we don't know where we're finishing the day for sure, okay? And we don't know what's going to happen next week. We don't know for sure if this bottom's going to stick. But we're calling a level 1, level 2, and level 3 bottom, meaning couple weeks from now, the level 3 will swing down. We're also calling a level 4 bottom, meaning a couple days from now, it will swing down, okay? And then it's going to swing up. And those level 4, level 3 should have somewhat of an upward bias in order to be in line with these larger level 2, level 1 trends that we think are now up. But we've got risk that we could be early, that it's going to be next week. And we also don't know how much this whole debt ceiling issue will cause problems this month even, okay? We may have to make revisions, so there's no way of knowing for sure this bottom's going to stick. All we can do is call it, manage our risk the best we can, and go for it. But it's important enough to consider that the market may rally into January, February, March for the next level 1 top. And so here's level 1 bottom. It should rally into level 1. That could be the first opportunity for a minor long-term top. And it might relate to only a couple of weeks of decline and put in a level 1 bottom, and believe it or not, would be the first opportunity for a minor long-term bear market and end of it, and then it's bullish for the rest of 2022. The problem is that can occur twice more throughout the year of next year. So I'm not going to be concerned for how I'm going to trade it. I'm not going to be concerned if I get those long-term tops and bottoms right. I just want to focus on the level 1s, and I want to take a little profit on some level 1s. I want to put that money right back in on level 1 bottoms, okay? And somewheres along the line, I'll find out, you know what, I also caught the minor long-term bear market. However, for you're paying me to provide all the information I can, all the signals I can. I'll do the best to call that LT3, but I'm a little concerned today, how well is it going to work next year? And I don't think it's really that important as we zoom out, and I'll explain it in a moment. But first, let's keep on track here. Level 1 rally into January, February, maybe even as late as March. Somewheres in there could be anywhere 1, 2, 3, 4 weeks of decline, range trade choppiness into a level 1 bottom. And then it's just going to go higher into May, June, July. Okay, that's the level 1 outlook of how they're going to buy. Because keep in mind, we're not just doing chart analysis here. We're saying the level 1 trader is going to see a reason to buy now into January. Therefore, we're saying that's a large enough trend, long enough, that we're likely going to get more bullish data, fundamentals, economics, news cycles, moods, sentiment than bearish, but both are always present. But the pendulum is going to swing bullish. This means this is a buy the dip. It was just the largest of the year and volatile and scary, and in my opinion, a bunch of BS and nonsense, and that we should have fixed that debt ceiling anyways. I'm with Janet Yellen. Take it away from Congress. I'm going to start talking more about this in future years here. I've come to the conclusion Congress and the president have too much on their plate. We're asking them to work too hard. There's too many things they need to be involved in and manage, and some of these things really ought to be for the professional, the career person who actually works with those things, instead of Congress just telling them do this or don't do that. In other words, I think it's time to switch it more to government. And the Treasury is government. The Federal Reserve is not government, by the way. It's separate, but it certainly has strong ties to government because government, in the sense of especially Congress and President, are telling the Federal Reserve, you got a mandate to keep this economy together, okay? Protect us from ourselves. All right. Anyways, enough on that. We're going to see more of that discussion because this is getting to be nonsense. Very, very tiring over this debt ceiling. And I'm now going to think, I wonder if can we develop a really large list that just takes stuff away from Congress and just do it as government, and then Congress can do a check and balance, and we as voters can say, no, government, you got to do that a bit different. Okay, different scenario. And I think it'll give us more stable markets and a stable economy, frankly. All right. Sorry, going off on that little rant, but let's now, this level 1 bullish move is probably going to break up with the most important correction to occur in November and December called the level 2. So the level 2 trader, they just can't help themselves. They got to trade a little more often than level 1. And it is still large enough to have something to do with the news cycle, the economics, the fundamentals. So the point is you can get some news there to drag it down. So the point is they're going to buy into November, probably sell sometime November, December, and they could buy all the way into December. I'm hopeful they buy into Thanksgiving. I've always had a general rule. They buy into Thanksgiving, then we get some profit taking in December. And we may do the same thing. The good news is, a few weeks ago, I told you it was probably going to be a level 1. It could be rather serious. The good news is, no. The model's saying, no, this was very serious, but it's going to end. We're going to get through it, and we're going back to buying stocks, and the world goes on. This is not an end-of-world moment, okay? And it's now saying, however, that we're still going to get some setback in November, December, but it should be minor now. It should not be as serious as this one. It may be because, remember, come December 3rd, from what I understand, we got to start this whole gap spending and maybe debt ceiling and whatever else could hit us again. And maybe it'll be more serious than we think. For the moment, I'm dialing in profit taking, and I'm hopeful it's going to smooth out because I can't remember the years, but it seems like there's been years where we had this debt ceiling problem, September, October, and something did get fixed only to December, but I don't remember December as being really a problem month, but I could be wrong. At any rate, the level 2 trader will then wake up, you know what? It's still a bull market. You know what? This thing's going higher. They're going to find the need to buy, and then they'll be back in line with the level 1. Okay? And then both sides are going to sell in January, February, March. That could be a more serious moment. And if it is an LT3 bear market, it could be even more serious. For the moment, I can't really come up with fundamental information and news cycle what that would be. And it's quite possible the market will get scared, change its mind, and the long-term top actually comes summer of next year or even later. So I want to be cautious on this long-term playing next year, because we got far more important things going on, the larger bull markets. All right. Anyways, we've got a weekly indicator still acting bearish, still worries me. It's still not oversold, but it's getting close now. Okay. We need to see this narrow, eventually turn up, eventually give us a buy signal. I think it'll be behind. I think it could be a week or 2 weeks behind what can go on with the market. I'll stick with my timing that's linked to trend following, whereas this indicator is more trend following. Trend following is always slower. You miss out of sometimes a lot, but you're trying to make sure everybody's on board with you, or you're on board with them, and most everybody is on board with that next trend, okay? So we have to take on risk here, and there's still risk when you look at the information news. It could be a tremendous downside still even, yet when you look at how prices flow, really most of the decline ought to be over if it's not bottoming, okay? We've knocked it down enough where some people ought to think, you know what, this whole debt thing will get fixed, and you know what, even if we went into a default, it would be a short-term headache. The market could crash for all I know. But I was talking to some farmers last night on commodities, and I said, you know what? It would cause short-term problems in commodities, and then the commodities would just rebound and do whatever they need to do. It might impact how high commodities that go on a long-term basis. It might create some complications in our exports, but you know what? People are still going to eat. Those boats are still going to get filled with grains and whatever else we're exporting, and we're still going to ship them. So really a default won't be that big a deal in the commodity sector, and I don't know why the stock market wouldn't wake up to that. There's not that big a deal, but it would be a subtle headache, headwind maybe, for years to come. So we shouldn't desire it, we shouldn't want it, and we should not allow it. It's nonsense, okay? But if it occurs, it could be devastating short term for us. On a long-term basis, it won't matter. We'll still have bull markets. The country will still grow economy-wise. People still have jobs. We're still going to spend money. Life goes on. The world's going to go on. It could have subtle headwinds, however, and complications in doing business for a very long time. All right. Any rate, that's our scenario. Want to be bullish now into January, February, March, realizing we'll get some kind of setback, realizing we don't know how fast this can recover because of this damage due to the debt ceiling here. All right, so I don't have a lot of upside objectives for you. I think by November this market could be record high, but I can't guarantee it. I think looking out to January, February, March, I could get even closer to possibly guarantee it. I think we're going to get through this somehow. We will resolve it. Now, I want to switch over to the monthly chart, zoom out for something more long-term. And now these lines aren't meant to be targets, support, resistance. They're general guidance of how I think this bull market can work. And it's pulling back to one of those lines. It got a little above one of the lines. It kind of respected it in here, and that could be nothing more than coincidence because they're not really analytical lines of forecast. They're general guidance. I think somehow this market moves higher, and this is our objectives for next year, probably in the 4,600s to 5,000. And we may only get near the minimum objective. We may not even meet the minimum objective. Put that minor long-term top end, the LT3, knock it down some, put a bottom in, put it up for the rest of the year into that target, but it really won't matter. What will matter is the more important target out in 2024 when I think the stock market's going to 5,000 to maybe over 6,000, maybe 6,400 even, okay? So, I'm sorry, not 5,000, 5,400, okay? I've got a target, my best target is 5,400 to 57, but I've come up with some scenarios to 6,000, and then I just kind of looked at this overall guidance, and I said, what the heck, throw it up there to around 6,400 or something, okay? So this is how the bull market's going to work, I think. Yes, I think we've seen the fastest, largest per year yields from the stock market, okay? I shouldn't say yields, returns, okay? So I think, yes, you've seen the best of fast money making, possibly, but I think also that what we have is that we've got still plenty of upside. The GDP, the economy should grow relative to that 9-year or juggler macroeconomic cycle. It should grow for 7 to 12 years. It's done it throughout the history of this country, in my opinion. I think I can find evidence over in Europe that it worked hundreds of years ago. I can find it in commodities easily going back a very long time. And then when you get into those super cycles, I can find those going back 800 to 1,000 years in commodities. And back then, commodities were the economy, in my opinion. From the 1500s to date, we evolved away from commodities, more so from, say, 1800, 1900s today, more towards technology, even more consumerism. But we've had 5 years of mercantilism, merchantism, consumerism, capitalism, and money printing and debt. And this country's printed money since the day it was born. So don't give me this crap that we've had all this money printing in the last 50, 100 years, that the Federal Reserve started all this money printing, and our forefathers were so much smarter and didn't have money. No. And you know what? Capitalism, and I forgot to get the name for you. I think I gave it to you a while ago. I'm reading a book on economics, walking us through the history of U.S. capitalism. Very, very interesting what's going on. And the economist made a comment. The problem with capitalism is it runs out of money. And I've warned you for years now, capitalism has flaws. It's not as great as that it's marketed. It's not as great as in the textbooks. In the free market, capitalism doesn't work as well. We have complications and problems. It blows up. It destroys itself every once in a while. And then we have to fix it. And it turns out, though, it's still probably a better system than all the economic systems, and all those other economic systems run out of money too. Communism, socialism, whatever else you come up with, they run out of money too. Everything and everybody runs out of money, okay? So in my opinion, there's always going to be money printing, no matter what you do. We may take a break from it at times and restructure, but in the end, we're probably going to print more money. And it's driving these trends for a decade, during a decade, and even shorter term. And believe it or not, it has an influence over multiple decades, multiple generations acting as one. Okay, and we're going to go into that story towards the end of this decade of what's going on with multiple generations and what will hit the market. For now, what I want you to think about is going higher, setback next year, going still higher into 2024. We could get a more serious setback, a minor or secondary recession, but we won't see it for the entire country. The economists won't say anything about it as a group. The U.S. won't probably call it. The Federal Reserve, I don't think, has ever really called a secondary recession. They've called double dips, but I don't think they've called secondaries. I could be wrong. It might be back in the 70s, 60s, 50s. Might have seen something like that. But at any rate, that secondary recession might be problematic for any of you who made a fortune during the virus recession. Same for businesses. It may be payback time during that time, but it won't be crucial. The stock market may not pay that much attention, but we could have a more serious setback. We could have more complications in commodities, maybe a little manufacturing. We could have complications in interest rates and inflation more than the economy and the stock market. All right, now, once that is complete, it should recycle, and this bull market should last into 2028 to 2031, maybe as late as 2032. There should be a bottom after a bear market for the stock market, also due 2028 to 2032. We can stretch out a little later. And we will have a primary recession. The U.S. will be in a recession. Now, it is possible for the first time in the history of this country, the Federal Reserve could print so much money and everybody have so much faith and go right to work and put that money to work that maybe in the first time in the history of the country we don't get a recession. But I don't think so. I think we're going to get a recession. It may be very mild, okay? But here's something else I want to talk about. I've been, since 2018 to now, and really aggressive this year, doing research in these super cycles. And I've come to the conclusion that this model, the DNA code from this model clock, really is showing there is no 1929 crash scenario for this century. It's early next, and that's so far out. Who knows? We could fix something. We could have the Federal Reserve buy the entire stock market if it drops 50%, and you'll never have a 1929 crash again. So no way am I betting on that, but it's saying if you need the exact code to have one, it's not now. It's not any of the nearby decades. It's probably early next century. Okay? Now, having said that, however, I've learned that we can have a super cycle bear market at the end of this decade with that long-term sell signal, long-term downturn, that primary recession. We could have a super cycle that relates probably back to early 1800s, late 1700s, and could be as much as a 70% drop in the stock market, not an 80 or 90% like 1929. That's still severe enough. But I'm not thinking we're going to have a depression, which can last a decade, like in the 1930s. I'm thinking more of maybe a Great Recession like 2008, 2009. And I'm also thinking we can manage this economy and markets better than ever as long as the Federal Reserve doesn't have its hands tied. We can protect ourselves from ourselves. And I'm only going to call a 40 to 60% drop, which would be a new statistic, not as bearish, for what are major super cycles that can be bearish at the end of this decade, just not as extreme as 1929, 1930s, okay? So I think we'll get new statistics. It'll be no more than a 40, 60% drop. It may not even be as severe as 2008, 2009, but we got some measurements may be as severe or more. I'm just saying I don't think the stock market goes low, and I don't think the economy will be more severe than, say, 2008, 2009, okay? And we'll fix that, and probably the stock market will be record highs in 2040s. If the super cycle did not show up in the 2030s, it should show up no later in 2040. For that model, I have a lower probability alternate model that says, no, it's really 2040 or 2050. So I'm willing to say no later than 2050. Things could go right or wrong with that forecast. So at the end of this decade, I'm going to first and foremost, once again, try to call that once a decade sell signal, like I did for the early 2000s recession, the 2008, 2009 financial crisis, and the 2020 virus pandemic thing. Okay, I'm going to try to call that. I'm personally taking all my money out, and any money I manage for people, I'm taking it all out. But I'm hopeful the country doesn't take all their money out, or we will have an 80 or 90% crash, and it's very unlikely that's what will occur, okay? Now, but I will put a warning, an asterisk and a warning with that forecast saying the super cycle may delay. And we may even get into it and fix it fast enough to save ourselves, but then for some reason it comes back to get us again in 2040. And I do think in 2050 there will be a minor super cycle drop. Something there will hit, but I don't think it's going to be the severe one. I think the severe one ought to be sooner than that. They both may be the same. We may get two of them, a big one in 2030, a big one in 2050, but again, they're not, the market doesn't drop more than 60%. Not that severe, in my opinion. All right, so for upside objectives for this decade, I think the stock market is going to 6,800s to 8,500s, and I can see that much economic growth for that growth cycle for the next 7 to 12 years, okay? And so I just don't see the models basically saying all these debt ceiling and all this political crap that's always going on, all the worries of printing too much money, all the worries of this and that, is not going to interfere with this, because on balance, we are going to keep enough money in the capitalistic free market system that the economy continues to work, we continue to work and do business, and unemployment is going to continue to work lower. It may turn sideways, and it doesn't have to go to extreme lows to keep me happy at all. It's almost low enough, but I want a little bit lower to where I would call it full employment, okay? And so I think this is all going to work out. And we just got to realize when we hear these things that could scare us into thinking, wow, we're going to have a 1929 crash. We've got to be cautious with that. When we hear stories, oh, we're going to fall into a recession, we're going to have a bear market, the country's going to fall apart. This stuff has worked so well for the history of this country, and I'm finding evidence of further back with other countries in Europe specifically. You're seeing you got to err on the side of this, that we're not going to give up on ourselves until we meet that 7 to 12 year economic growth thing. And you want to calculate it from last year. And I think it means 2028 to 2031 is where we can expect the trouble, that we cannot afford to pay any higher for anything. Labor, stuff in the store, commodities. We cannot afford to hire more. We cannot afford to spend more. And even if we could, we don't want to. That there can be this element in there of thinking that, gosh, I shouldn't be doing this. And that creates some of the problems. And if you pull the money away, then it creates even more problems, which is why Ben Bernanke, studying depressions, realized you got to at least keep the money there. Then if people want to shut down businesses, so what? But chances are it's not going to turn into depression as long as you keep the money there, because then they can do business if they want. Those are the things we got to watch out for this decade, and I'm very confident we're going to get these higher objectives. I might not be exact on these price levels. The timing might be a little off on the way. We could have larger down moves than I forecast, and bad news more serious than I think. But some of this really is more of a mental issue of how we tend to overreact on the downside. So anyways, I'm actually comfortable with this setback. Look at this. It's no different than back in late last year, going in election kind of times. And next year, we'll probably get another setback and worry over the elections. Obviously, in 2024, we'll worry over the elections. But there's so much going on to this story. We, the people, run the economy, not the Federal Reserve, Treasury, and the government, okay? They add to it or take away. Keep that in mind. So bottom line is, I think this is probably a buy the dip moment going on in the stock market. Now, I want to look at some outside markets, and I'm going to flip to interest rates. I'll do the bonds too to kind of help out those. Because sometimes we come up a little bit different view on the interest rates. I think interest rates are rallying into a level 2 top, pull back here in a few weeks, which probably means we're going to fix the debt ceiling, things will be okay. But there is a reason for them to rally into the end of the year. That's probably because they're going to worry over the next issue come December 3rd for all this government debt stuff. And then there'll probably be a setback that it may worry about issues early next year, a little bit on the economy maybe, okay? But I still see nothing but a range trade, okay, for interest rates going into some kind of minor long-term bottom next year. I think we've seen a minor long-term top. Even if I'm wrong and I push this to a new high for interest rates since last year, I think it'll be unsustainable to pull back again. And I don't know next year that this bottom is going to be lower than this. It should be, but I don't think we really got that kind of structure. It's not going to be an ideal scenario. I think it's going to range trade right in here for quite some time for interest rates. And then eventually it's going higher by 2023, if not late 2022, and may stay higher into 2024. And I do see 1.8, 2%, a little over 2% interest rates. Later this decade, we'll recycle and keep doing these things, up and down, but mostly up, where we could have, for all I know, 3, 4% interest rates going out towards the end of this decade. Then we'll hit peak economy, peak interest rates, peak stock market, everything's coming down. And they may bring interest rates all the way back to 1% for all I know. I doubt they're going lower than what we've seen, because I think this last year we put in a super cycle bottom, and that super cycle is likely higher into next decade, if not the following and maybe the following. Okay? And I think inflation is going to do similar things. It's going to look like this interest rates somewhat, that it can be even higher in the next date. I think the Federal Reserve has switched from a monetary policy to a fiscal policy, which sounds more like the 1950s, 60s, 70s. And I know a lot of people think we're in the 70s right now, and they're calling stagflation, and I don't see it. And there's just as many or more people saying, no, it won't be stagflation. So I'm with them, okay? But there's no question about it. There's two sides arguing here, okay? I don't think it's time for the 70s yet. It could happen, because I do think there's a chance for this super cycle to be shorter than normal. Things can be compressed, develop faster. But I don't think so. I think the 70s will be next decade, and ideally even later. So we can have even higher commodities by next decade, higher inflation, higher interest rates by next decade. But along the way, we can have some large setbacks, especially in commodities, because you can crank up your production because you put the price too high, okay? Anyways, that's my interest rate scenario. We're in a super cycle bull market, and along with inflation, but we're still in super cycle bull markets for the economy and stock market, at least to the end of this decade. Then we can readdress what's going on. And maybe that whole inflation scenario going out to 2040, 2050 and higher interest rates might be a clue that this super cycle in 2030 isn't going to hit. It's actually 2040 or 2050, or we're going to get more than one type of an event like that. It's going to be something more complicated, a process. Now, for those of you that prefer bond prices, you trade bonds. Big revision last night, okay? And what it's saying is level one bottom, bit different than what I would have thought relative to just interest rates. Brief bounce into a level two top, sets back to really less important bottoms, doesn't matter. Therefore, this level two isn't going to matter. Instead, interest rates move higher into level one top early next year. That's something like what I was showing you for interest rates, somewhat, okay? Interesting that they're the same thing, but we can come up with a little bit different scenario, price versus interest rates at times. This thing is quite oversold, trying to work for a buy signal. I think the bond market is already betting we're going to fix the debt ceiling. Even if we don't, we'll probably fix it so fast this isn't going to be a crash and burn environment. Well, we don't know that for sure. Okay, and I don't know what a default. Most people say default will make explosive interest rates, but what if the bond market just sees a deflation, economic recession, or depression out of a default? Then seems like interest rates would crash and burn, frankly. All right, enough on that. Let's move to the dollar. For those of you who like to trade the dollar along with stock, I think this is topping for level one top this week. I think it's lower the next few weeks. But I also think it's in a range that's within a range that's within a range. I think there can be some kind of minor bullishness or range trade into, if not through next year. But I think there's a chance looking out by 23 and 24 and maybe some of 22, the dollar can swing lower, because I think we're still in a major long-term bear market. But I don't know if the dollar index is going to go any lower than what we've seen. For years now, I've wanted 85, and I'm beginning to think I'm not going to get it on the dollar index. It's going to be in the upper 80s. But we could revisit 90 or lower in the next few years, along with an inflation story, a commodity story, a growing economy story, and the interest rates may not move high enough, fast enough, so that the dollar trader will say, you know what, I'm not going to buy the dollar because of interest rates. I'm going to sell the dollar because of these other things, okay? But I think you can look for a little short-term trading opportunity on the downside in the dollar here, and just realize I think we're probably in a trading range for quite a while. Now, this is gold. I think it's a range trade here. We got a conflict. Level one top due, level two bottom due. Don't know which is coming first. If the bottom comes in ahead of the top, not a good sign. It could be down for quite a while. If the top comes in just ahead of the bottom, more range trade for a little while, but a chance it could still be bullish farther out. The minor long-term cycle could have bottomed this year, and it could be bullish into 2023, and it could take to a record high of gold and then put in a major long-term top, and then gold won't do much of anything for 3 to 5 years after that. But there's an alternate scenario saying the current record high is the major long-term top. You're either just going to get range trade into 2023, no record high, and then put in a minor long-term, then bearish, and more likely a larger range trade for a while. Or there's a possibility that it's just going to be bearish now in the next few years and then range trades for a few years, which means there is a chance to violate this year's low. If it violates this year's low this year or next, I am long-term bearish probably into 23. I may be long-term bearish to late this decade, but being bearish that long, I'm more inclined to say range trade and not a tremendous amount of downside for gold, because there will be enough inflation during this decade and worries over all kinds of complications problems to support it, but it may not be a good inflation hedge tool. The inflation may not be strong enough to excite gold here. So you bulls need to keep gold from going below this year's low here for a while, and then you have an opportunity. You could get a record high by 23 or something, and then I see complications and problems for a while, even though the economy will grow, even though we'll have higher inflation. Now, next century or next decade, I do see still higher gold prices, but I also see from 2040s into 2070s a chance for lower gold prices, or at least one decade that's not very good for gold. Moving on to Bitcoin, which I'm thinking has a bit of correlation to gold right now. So Bitcoin, same story. If it violates the low of this year and does it this year into early next year, a little bit different than the gold scenario, I want to be long-term bearish Bitcoin for a while and see if it works. Don't know if I can guarantee it. Still don't have enough history to really help you with confidence in the long-term scenarios. At any rate, we've been looking for a level 2 bottom. I think we're going to get it. And if it can rally up and take out the recent high, then we could still have more upside, maybe even to a record high, that a mid-size long-term top, possibly even a major long-term top, won't occur for a while yet. So the bull could still live here, and I can see probing the upside in Bitcoin right now. Not so sure about gold, but I'm kind of thinking there might be some kind of connection or correlation there. Crude oil, I think this is an economic indicator. The economy is hanging in there, doing well. But it's also a lot of microeconomics going on, and the demand and supply demand, the supply chain issues in China, and now issues in Europe. And I called a long-term top twice here. I got a feeling it's going still higher later this year, and I'll have to call it the third time. I still see a setback for commodities in general by next year. Some of them I think have already started. Thought it started for crude oil. Now I'm concerned it's going higher. However, near term, oil should dip a little bit, then go higher. And if we're lucky that it dipped a lot, then maybe this final rally won't take it to a new high for the year, and we'll find out this long-term call worked after all. But this is too close of a double top for me, and I'm just concerned this is not that important of a top right now, even though it's overbought. So I'm a little bit concerned to ease it back, take it still higher, a new high for the year later this year, and it probably will relate as contagion, or at least the bet of contagion off of European prices. I'm not convinced European prices are going to cause contagion, but I also know China has its own issues, okay? So there could be things to extend this. I don't think OPEC really wants to see these higher prices. I think they'll pump all they can, but it could still last a bit longer. I think we'll see lower prices next year. We just got to get through winter and the European scenario and maybe resolve some things in China. This could be a negative factor somewhat for the economy of keeping prices too higher, but mostly I agree with a bank that come out saying these prices are going to hurt demand for oil. But they didn't say anything about the economy. I don't think it's going to be that serious looking out for our long-term bull market. So that's all I've got for some of the outside markets. Now, of course, some of you like to follow the VIX for the stock market. And my chart is always not scaled correctly here for some reason. I think we've seen a level 2 top in VIX, and the stock market is done going down, but I could be wrong, okay? And notice we've got some serious moves in the stock market, but the VIX don't really look that serious to me. I think there's an overall long-term trend of keeping the VIX somewhat stable, maybe somewhat lower here. And I think this just means long-term bull market. So I'm ready for a setback in VIX, but I could be early, I could be wrong, and the debt ceiling will interfere with that, okay? Now, we have to also keep in mind that a good portion of the stock market has not done well for months now, and it's been struggling, but it looks like to me that even with this hard hit in the S&P 500, NASDAQ, Dow Jones, that those stocks that have been dragging their feet for months now, some of them even going down, some of them are down 20, 30% or something like that, they really didn't take the hit that we've seen here this week and last week and the prior week. They really didn't take the hit there. And I think that tells me they're already low priced. And I think there's something going on where they're going to improve next year and on into 2024. But I also think it might be a struggle higher from here, and we've got to get to the, we could have that minor long-term top and bottom for the S&P 500, NASDAQ, and Dow Jones next year. That could be a headwind even for those stocks, but there might be more safety in those stocks. And somehow we got to get those major indexes on board with those stocks that already got beat up, because I think they've already seen their long-term bear market. I don't think there's a lot more for them to go down, but there could be complications and problems for us in those major indexes next year. And of course, we know there could be problems with this debt ceiling near term. But I think that all resolves, and somehow we get more of the stock market on board with one another, that at least by late next year on into 2024, we get a nice stock market going yet again, okay? And again, though, keep in mind, I do think there is a possibility that we can have not so bullish yields and returns coming out of the stock market here. Here is the India index. Wished I'd bought more of that and dumped the U.S. Looking very strong. I think it'll put in a minor long-term top next year along with the U.S., and I think there's much more to come from India all the way into 2040. Here's the French CAC index. Basically setting back along with the U.S. This should be at least a level 2. It might be a little different in the U.S., at least a level 2, but it may be level 1. And I think they're still higher into early next year. Here is the China index. Rather complicated because there's some indicators not so well. They're trying to work even harder and better than we are on our inequality, on readjusting capitalism, making sure they don't get out of hand. And then, of course, they got the real estate corporate blowout there and debt with that. And their stock market is doing fairly well hanging on to that. I'm a little concerned. I'm thinking it's going to bounce early next year, but I think it's sluggish. I don't think it's going to perform as well. But later this decade might have something more bullish for you in terms of China. And then where's my German DAX? We want to take a look at that. Now, a larger setback here in line with the U.S., but still coming up with a scenario. It's going to bounce by early next year. Then maybe we'll get a large setback. I think it bounces later this decade. Quickly, what else do we have going on here? I'm going to skip Italy, Spain, all of that. Here's the Nikkei. And very pleased it bounced, but I think it's bouncing into minor long-term top early next year. But like the U.S., it could delay to summer, even to fall. It could be difficult to time, but I'm very pleased it woke up and pleased it's not responding that much, I don't think, to the U.S. setup, debt ceiling. I think something is going on that's pleasant for Japan, frankly. But we do have this kind of minor long-term setback due sometime next year for Japan as well. But I think there's more upside later this decade. I think the whole world is somewhat in line with what we're forecasting for the U.S. market. And here's South Korea. I'm so pleased at how well they're doing. But I think they'll run into that minor long-term complication next year as well. But I'm pleased they're paying no attention to the U.S., paying no attention to the global setback that's related to the U.S. Love it. Looking good. Don't have a clue whether it's overvalued or not. Is it still a buy or not? All I can say is I wouldn't have gigantic sell stops on it. I'd keep the sell stops kind of close to monthly lows, but I think you can give it a chance here. It's going to continue higher. I think it's leading U.S. higher now. That's pretty much all I've got for you at the moment here. That's a growth fund, the IWF fund. Big setback this month, but I think it's probably got higher coming down the road. All right, so let's wrap this up. I think I'll return to actually what we were doing on the intraday chart here, see where we're at, and still looking strong. The market's a little hesitating now. They're waiting on the open. They want to see will the cash market sell this bounce or not. And I got a mixed picture when looking at 5-minute to 20 and hourly and things like that. I do think there can be some setbacks today, but I'm gonna be brave, try to be brave, and say this market's going higher into Monday. I think it's going higher next week. I think it's going higher into November. I think we'll have to deal with this debt stuff again in November, December. I think that we still have problems and complications that can occur next week. And who knows, maybe something could go wrong that October is just not going to be a good month. But my understanding on the seasonal is September is actually the worst month, but they simplify it and say September and October are the worst months of the year. November and December are the best months. That's for the history of the U.S. Anyways, I think you can probe the buy side if you haven't already done it. I'm calling a level 1 bottom in here. Just realize I could be early going into next week. And then I may not understand how this debt stuff could cause problems all the way through October. I can come up with some very low probability alternate scenarios in the markets, right from the model even. But you got to give me the input. You got to show me how serious this debt issue is. Anyway, for those of you who are planning on buying November, December, because you buy level 1 bottoms only, or you buy more on level 1 than you do level 2, and you're a long-term investor and you're just trying to keep accumulating, keep buying, I think this is a better buy the dip than what we're going to get in November, December, frankly. Okay, and again, I think the market was higher into November, sets back just for a couple of weeks. It could even go higher into the beginning of December and sets back a couple of weeks. I can't tell you for sure right now. I want to say be bullish into November is my best forecast for the U.S. stock market right now. And obviously I'll be wrong if they take out the overnight low in the futures, okay, and whatever the related low is in the cash market. So keep an eye on it. But we could be setting up now for bear traps that people might sell it lower and be sorry later they were selling too low of a price relative to what's really going on with the economy and the long-term bull market for the U.S. I do not see this debt stuff as an end-of-world scenario. Past results are not necessarily indicative of future results. Have a great day. Have a great weekend. Stay safe. Stay healthy. And here's hopeful we're on the right track.